Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your rates rundown for May 1st, 2026. I gave a little overview of the current state of mortgage markets and how we got there last week, and all those themes still apply. If you want a little refresher, you should go to my channel homepage and have a look, and also the link will be right about here at the end of this video. The punchline is that rates continue to be caught in a push pull battle between geopolitics and macroeconomic data. Truthfully, geopolitics have played the more dominant role, but data remains an important backdrop. Speaking of data, that leads us to our benchmarks. 10-year treasury yields are higher this week by a little over 6 basis points to 4.37%. And the 30-year fixed mortgage rate is higher by 11 basis points to right around 6.55%. Now, reflecting on this past week, it's been a really wild ride. Mortgage rates spiked after reports suggested the possibility of a prolonged blockade of the Strait of Hormuz. That sent oil prices back up above $100 a barrel and 10-year treasury yields into the 440s. Then we saw a little bit of a relief rally, perhaps maybe partially due to weaker than expected economic growth data. We're rallying just a little bit off the lows for today on news or maybe rumor, maybe hope of some marginal progress on a new peace deal being proposed by Pakistan. And to complicate matters, all this happened in the same week as a milestone Fed meeting. And given the fact that geopolitics and data continue to point in a similar direction to where we've been headed for several weeks now, we're going to focus this week on the Fed decision. As expected, the Fed elected to keep their rate unchanged once again. That makes three consecutive holds for 2026, but that doesn't mean it wasn't a notable meeting. Four FOMC members cast dissenting votes, making this decision an 8-4 vote. It's an unusual outcome and the first time we've had this many dissenting votes since 1992. Stephen Myron has effectively made himself an afterthought at this point by voting once again for a cut. No respectable economist out there that I know of would be advocating for an additional easing while inflation is this high and moving higher and unemployment is at historical lows. It just doesn't make sense. But critically, three members dissented because they objected to the retention of an easing bias in the statement, signaling that a meaningful faction of the committee is uncomfortable with the notion that the language in the statement leans towards additional cuts in the future. They would rather deliver a message that says rate hikes are just as likely as rate cuts moving forward. And presumably, if a hike was on the table this time around, some of them may have even voted that way due to the persistent inflation pressure. Also notable was that this was most likely Jerome Powell's final meeting as Fed chair. And he announced that he'll be staying on as a member of the board for an undefined period of time. So that adds another layer of uncertainty. You've got a transition to a Kevin Warsh as the new Fed chair, a fractured view on the appropriate path of rate policy going forward, and a still influential Jerome Powell now free to vote his conscience rather than build consensus. So, where does that leave us? Well, I'd say mortgage markets enter May in a state of heightened caution. On one hand, home prices continue to advance and demand remains strong despite higher rates. There's also no Fed meeting in May, so that's one less source of volatility we have to worry about, and those are all good things. On the other hand, we have persistent inflation, geopolitical volatility, and a newly divided Fed. All those are bad. And if I had a third hand, I'd probably put overall economic growth and, in particular, jobs in that one. And that's been a little bit more of a mixed bag. We're going to get some insight into that next week with the payrolls report. A big surprise in either direction could be a market mover, but unemployment has been pretty stable in like the low fours for like a year and a half now. So I don't necessarily expect that to be the case. So all this is to say, don't expect volatility to subside anytime soon. Significant progress on a peace deal could result in mortgage rates reaching back into the 6.25 area. But I don't see us testing the February lows where mortgages, started with a 5 until we find a permanent solution that will allow shippers and more importantly their insurers to allow boats to start moving again. Barring any of that, I think these mid to upper sixes is where mortgage rates will sort of rest for the time being. That's all I got this week, folks. Hope you have a great weekend, and we'll see you next time.